Welcome to the video on RSP plans presented by PAPE Canada. So in this video, we're going to go over a whole lot of information. And of course, if you'd like to read up on it and learn more about it, we're going to link to the website where we have information on different retirement plans. As well, the book Elmer's Nine and Dine is available on Amazon.ca. So the first thing, if you're looking for information on spousal RSPs or pension adjustment reversals, we're not going to be discussing those in this particular video. We have separate standalone videos that deal with those particular topics. We're going to specifically address RSP plans in this video. So what's an RSP? Well, an RSP is basically a plan that the government of Canada allows Canadians to have to open, where you put in money that you've earned, and by putting it into the RSP, you get a tax deduction, meaning you don't have to pay tax on the amount contributed, and that way the amount inside the RSP is pre-tax income, and when you take it out of the RSP or the RIF, you then pay tax. So, while you're working, you earn income. You put it into an RSP, and you get a tax deduction. By the end of the year that you turn 71, or before that if you retire before, your RSP must be converted to a RIF, or you can buy an annuity maybe. If you take a withdrawal from the RSP or the RIF, you have an income inclusion. So if you're sitting there going, so I'm paying tax no matter what, that is correct. You'll get a tax deduction. So if you earn $100,000, put $10,000 into the RSP, you pay tax on $90,000. Your employer probably doesn't know that you're going to put the $10,000 in. So the employer is taking withholding taxes at source for the $100,000 of income, but when you file your taxes, you settle up with the government, and they'll give you a refund if you're owed that money. So it's nice, it's a good feeling, you get money back. Okay? In fact, that's an interest-free loan you're giving to the government, so you don't want to do that. It's preferable to go to your employer and say, hey, I'm going to make RSP contributions, I want you to take off less money. So, eventually, it's an income inclusion when you're taking it out of your RIF. The expectation is that you will be in a lower marginal rate of tax in retirement than while you're working. And that way, you'll save tax at a higher marginal rate of tax, you'll pay tax at a lower marginal rate of tax. That's the premise behind the RSP. Of course, we have a video that compares the RSP and the TFSA if you're interested. So, the question is, how much can I put into an RSP? Well, to avoid very high income earners, like people who make $10 million and only need $1 million to live, if they could put the difference into their RSP, the $9 million, wouldn't that be great? They would never have to pay tax. Well, the government said, hold on here. Every single year we're going to have a maximum amount, and we're going to increase that according to inflation. So the maximum amounts in 2022 and 2023. For 2022, you can put $29,210 into an RSP. And for 2023, you can deposit a maximum of $30,780 if your income is high enough. These are the maximums. In fact, your maximum contribution, how much you can put into an RSP, is 18% of the previous year's earned income and you're going to minus the pension adjustment, I'll explain that in a moment, plus the previous year's unused room. So, as an example, if somebody were earning $100,000 a year they would be able to deposit for this year $18,000, which is 18% of $100,000 into the RSP. If they earned, let's say, $400,000 a year, that would be $72,000. Well, that's more than the maximum, so then they get the maximum. So you get 18% of your previous year's earned income up to the maximum. That's how it works. For those who are working for an employer who's generous, who provides a defined benefit pension plan, when the employer puts money into that plan for the employee, there's what's called a pension adjustment. There's a specific video that I've done on defined benefit pension plans. Out of all of our videos, it's probably going to be one of the most popular. I'll link to it as well. You can listen to that video if you'd like. It explains the calculations behind the PA. But basically, if you have a defined benefit pension plan, that removes the RSP contribution room. You can't double dip just because your employer is generous. It's one or the other. And of course, there's a previous year's unused room. So if I'm working and I'm earning $100,000 a year, it makes me quite happy. That means I can put in or deposit $18,000 a year. In my particular case, my employer does not have a defined benefit pension plan. So I can put in $18,000. For the last 10 years, I've been earning the same amount and I've never made a contribution. Well, that's 18, or call it 9 years. So 9 years times 18,000 plus $18,000 is 10 years at 18,000, so it's $180,000. That's how much I can deposit into my RSP this year. Because if I don't make a contribution and I accrue room, I create unused RSP room, it will carry forward indefinitely. So until I die, the room keeps carrying forward. As we discussed, you can only have an RSP until the end of the year you turn 71. Well, if I can't have an RSP after that, I can't make any contributions. So basically, it's good until the year I turn 71. Obviously, if I have $180,000 of room and I earn $100,000 in income, it doesn't make sense to deposit $180,000. I can only get a tax deduction up to my income. So you wouldn't do that in 1 year. You would do it over a series of years if ever you found that money, you sold a property, inherited money, or maybe you won the lottery, okay? So, as part of a financial planning exercise, if you are married, if you have a spouse, it's very good to utilize registered plans. And the reason is that RSP plans in all provinces except Quebec are allowed to put a beneficiary on the plan. Now, I could name anybody as the beneficiary. I could name a niece or nephew, I could name a friend, I could name a parent, I could name anybody. What happens is that if I die tomorrow, the money inside of the RSP plan does not go through probate where it becomes part of my whole estate and all the rest of it. That takes time to work its way through. Somebody has to administer it. If I have a will, if I don't have a will, they've got to go to court to get the power to administer it. Then they administer it. Then it goes through a process. It takes a long time. Well, maybe my niece or nephew's in post-secondary education. I want to leave them some money. They can pay their bills for school. If I name a beneficiary, they get it straight away. Okay? Obviously, the money comes out. It has to be declared as taxes. There's withholding tax. We'll discuss that in a moment. But if it's my spouse, he or she could be a successor holder. So instead of the money coming out of the RSP plan and being counted as income for the beneficiary, my spouse, he or she could take over the plan as is. So the money inside of the RSP, which is tax sheltered, remains inside of the RSP. It remains tax sheltered, but it's now in the name of my spouse. It will not impact his or her unused RSP room. They simply inherit the account from me because I've died. If you are undertaking a financial plan, this is a very valuable tool to say, I want my spouse to be my successor holder. He or she would like me to be the successor holder. That way we avoid collapsing the plan and a large amount of tax to be paid. All right. Again, only a spouse can be a successor holder. You can't make it a friend of yours or anything like that, okay? Of course, the RSP can hold a number of different investment products: cash, GICs, mutual funds, segregated funds, stocks, bonds, exchange-traded funds. The RSP, the TFSA, all of those things are government plans. What you put inside the plan depends on where you open the RSP, what products and services are being offered, and what annual fee that you're paying. If you go with a full-service advisor or a discount broker, you can get access to all the products. But if you don't want to pay an annual fee, you just walk into a bank branch, they might say, well, we have this mutual fund or we have this GIC and there's no annual fee for it. Well, then you only have access to those mutual funds or those GICs. Next up, I want to discuss with you the withdrawals from an RSP. Although at age 71 you should be, or earlier when you retire, you move the RSP into a RIF where there's a minimum annual payment that is required. Even though that's the intent, it could be that you lose your job or the roof falls in or whatever it is, and you need money out of the RSP. There's no other way to get it. So, RSP withdrawals count as earned income for the year, and you are taxed on them. Unlike employment income, where you have to make EI contributions and CPP contributions, you don't have to do that for the RSP. It counts as other income. When you take money out of the RSP, the room is not allocated back. It's simply given up or it disappears. Although you pay taxes at your marginal rate of tax, financial institutions in all provinces except Quebec, and the rates are just different for Quebec, are required to take withholding tax depending on how much that you take out. And so what happens is this: if you take out $0 to $5,000, the withholding tax is 10%. If you take out $5,000 to $15,000, it's 20%. If you take out $15,000 plus, it's 30%. In Quebec, the province and the federal government take a different amount. We're not going to be covering that in this video. What a lot of people will do, they'll say, well, why would I need $20,000? And so they try to get 20, but then all of a sudden they're losing $6,000 to taxes. They're saying, I'm not working, I'm not making any money this year. At the end of the year, you have to settle up with the taxman, the CRA. Canada Revenue Agency looks at the total of all your sources of income and says, okay, you made so much, multiplied by the marginal rates of tax, you owe us this much in tax. If you owe 30% and you only withdrew $5,000, you have to pay the difference. If you owe, let's say, 20% and they took out 30 because you took out 20,000, they will refund the difference. This is not a big game of I won't have to pay it. You'll have to pay it at the end of the year. The financial institution is required to report it to the Canada Revenue Agency and you settle up. Now, it used to be 10 or 20 years ago, people would say, well, I really need the money, I don't want to deal with this right now. So they'd call, they'd take out $5,000. A few days later, they'd call their financial institution, take out another $5,000. They'd do this over a few different weeks. Eventually, one of these organizations, probably one of the big banks which has the better software systems and more money to get the best software systems, they were audited. They said, well, why didn't you pick up on this? Why didn't you do this? So of course, it took one of the banks or very large insurance companies, the big financial institutions, to go out and get software that said, we're picking up on the previous withdrawals that you did a week ago, everything from January the 1st, and some of them now are saying, okay, the total is this, we're charging you the difference because now you took 5, you took another 5, we're taking the 20% on everything plus the difference for the last one, the 10%. Not every financial institution does that, but If they're large in scale and they have the technology to, they are now required to. And so if you're going to be taking money out of your RSP, you're going to want to call and ask the best way to do it to see what they're doing. And at the same time, if you take 5, you take another 5, don't be surprised if you get less for the second time. All right, there's 2 more points to discuss. One is that if you're not happy with your financial institution, you can't take the money out and cross the street and say, here's the money, because you had access to it, so you'd have to pay the withholding tax. So people say, well, how do I go to my bank and say, I don't like you and I want to move it? The answer is you don't go to the bank that you currently have it with. You go to financial institution number 2, where you want to move the money to. You sit and you explain it to somebody. And they'll say, that's fine. We have this lovely form. It's called a transfer form, or a T2033. You fill it out. We check off the box RSP. You bring me the statement from the other place. We're going to go ahead and fax it to them, and then they'll cash out your investment, or we can maybe do it in kind, depending on what you're holding, and they'll send it over here. So you go to the institution you want to move the money to, fill out the form, they'll deal with the old place. You don't have to deal with them. Of course, if the old place is any good, they're going to give you a call. Is there anything we can do, and all that sort of thing. Last up is what constitutes earned income for RSP purposes. And there's a few different things. First of all, if you have employment income or you have business income, those count. Of course, if you have business losses, those count as well. If you have, let's say, a rental property and you make net rental income, that counts as well. Very quickly, if you have, let's say, a condo or a home, you're renting it out for $3,000 a month, your net rental income is not $36,000. It's whatever minus whatever expenses. So if you have a mortgage with interest expense, you have to deduct that from the 36. It's the net amount after all deductions, and deductions include capital cost allowance if you're taking it. If you don't know what capital cost allowance is, you're probably not taking it, so you don't need to worry about it. Royalties also count. If you get CPP or QPP disability payments, not the retirement payments, but disability payments, those count, okay? Because those are a substitute for income. And of course, if you have taxable alimony, meaning your spouse is paying you and you have to declare that as income, and it has to be every month, you have to include that in your income. If you're the spouse paying it to another spouse, you have to subtract it from income. On that, we do have additional videos on the home buyer's plan, the lifelong learning plan, as well as spousal plans and pension plans, which include the pension adjustment reversal. If you would like to learn more about retirement planning or retirement income, on our website we give away the first 2 chapters of Elmer's Nine and Dine, which is a guide to retirement planning. The full book is available on Amazon.ca. Thank you again for listening, and we'll speak to you again soon.